Assalamualaikum and hello everyone. Welcome back to my channel. Today we are going to focus on consolidation, and we now move on to intercompany or intra-group balances and transaction. This is part 1 of a video. We are going to focus on the following: intra-group transactions and intra-group balances. Intra-group transactions occur when parent and subsidiaries traded and conduct business transaction with each other. This means that it involves transaction between group members such as parent and subsidiary, or subsidiary with another subsidiary, as follows. For example, intra-group loans. Intra-group loans where maybe parent is the one that lend money to the subsidiary and subsidiary is the borrower. Intra-group trade receivables and payable. Let's say the subsidiary is the seller and the subsidiary sells goods to the parent. So that is intra-group trade receivables if the goods are sold just between group members. So that gives rise to intra-group trade receivables and intra-group trade payables. Current account. Normally, for companies that have numerous intercompany transactions, it will have a special account called current account to maintain and keep record on these various numerous intercompany transactions. Intragroup balance here is relating, another one is relating to bills payable and bill receivable. Intragroup interest. Maybe subsidiary declare debenture interest and parent has the share of interest in the subsidiary. However, this will not be covered in this video. It will be covered in the next video. Intragroup dividends will be covered in the next video. Unrealized profit on sales of inventory. This will be covered in a different video, as well as unrealized profits on sales of non-current asset. Okay, for your information, you can refer to the textbook, note 10.8, page 322. The textbook that I'm using is Company Accounts and Group Reporting by Jane Laza, the one that was published in 2019. So it's the 9th edition. So you can look at illustration at page 373 and also look at note 10.84, read that, self-study that, page 374, and go through the example 14 at page 375 to page 378. I'm not going to cover that. That is your responsibility, and to do that as a self-study example. However, I will cover my own example here. So what is actually intra-group transaction? These are transactions, as I mentioned earlier, that happen between group members. So in the preparation of consolidated financial statement, all intra-group transaction or intercompany transaction have to be eliminated. So intra-group transaction won't be reported in the consolidated financial statement. Here we are talking about in the context of consolidated statement of financial position. The reason is because the group are now considered as part of a single unit for consolidation and group reporting purpose. The elimination are done to avoid double counting of asset and liabilities, as the consolidated statement of financial position present asset, liabilities, and equity. So therefore, it has to be eliminated to avoid double counting, as the objective of the consolidated statement of financial position is just to report and disclose transactions that have taken place between the group and the outside party or the third party, between the subsidiary and the outside party, and also between the parent that relates to the transaction with the outsiders or the third party. However, in the case of intra-group transaction, there will be situation where one member, maybe the parent, maybe the subsidiary, made a remittance, but the other party has not received it yet, or they were not aware of the receipt of this particular remittance. For example, these things are what you call items in transit. Example are items like cash that was remitted by one party and or maybe items like inventories that was remitted by one party, but the recipient party, let's say the subsidiary is the recipient party, and the party that remitted or delivered the inventories or delivered the cash payment is the parent. So the recipient party here, let's say, is the subsidiary, has not received them as at the reporting date, which is the date the preparation of a consolidated financial statement is being made. So therefore, this is considered as items in transit. For the goods, this is considered as goods in transit. And this normally happen in the situation where subsidiaries transacted in the form of sale of goods, or maybe the parent also transacted in the form of purchase of goods between group members on credit. So the cash remittance that have been paid perhaps by the subsidiary has not been received by the parent, if the case where parent is the seller and the subsidiary is the buyer. So that will be covered later. Just now I mentioned about current account. So if parent and subsidiary have numerous intra-group transactions with each other, this will probably involve numerous amount due to and from each other. And to make it more convenient, these intra-group transactions are usually recorded within a single account in each parent and subsidiary. And this account is termed as current account or called current account. So these amount owing within the group rather than the third parties, as I mentioned, the amount owing within the group is intra-group transaction. This will be recorded in a single account called current account if they have numerous intercompany transactions. However, for the preparation of consolidated statement of financial position, the current account balances must not be disclosed. I repeat again, must not be disclosed. And therefore, we need to eliminate or cancel off in the preparation of consolidated statement of financial position. So we have to perform consolidation adjustment to cancel off the balances in current account. The balances in current account may differ, meaning to say that it may not agree. Let's say the current account balances of the parent might be 100,000 and the current account balances of the subsidiary might be 80,000. So the difference of 20,000 is the case where maybe one group member has recognized certain item, but the other group member, the parent for example, is not yet aware. Probably that was due to the fact that the item has not reached the recipient. As such, any differences in the current account balances may arise, and therefore these are quite common to see that those differences arise to item that are related to cash in transit. It might due to items like cash in transit, or I mentioned earlier that was called items in transit, or maybe goods in transit. Cash in transit is the payment of cash that was delivered but has not yet reached the recipient. Goods in transit is the goods that were delivered but also has not yet reached the recipient. It is still in transit. And therefore, these differences in current account will have to be cancelled off against each other. And we need to go and check what are the causes of the differences in the current account. So now we move on to specific discussion on cash in transit and goods in transit. Remember, these are items in transit. As at reporting date, the current account or the intra-group receivables and payables, if you have transacted between parent and subsidiaries or maybe among subsidiaries themselves that are controlled by the same parent, it may show different balances due to the existence of these in-transit items such as goods or cash in transit. So the golden rules here, what are the golden rules here? Is to provide consolidation as follows. So I'm taking these some of this material from the Applied Skills Financial Reporting ACCA study text that is published by Kaplan. So these are the source of reference, some of it. So if there are goods or cash in transit, consolidation adjustment is performed. So you need to perform consolidation adjustment. So that is normally done by the parent in its worksheet, as if the goods or cash has been received, even though it has not been received, but the consolidation adjustment need to be done as if the goods or cash has been received by the recipient. Okay, so let's say we have cash in transit. The cash has been paid, but we have not yet received the cash as a recipient. So as for the purpose of consolidation, what you need to do is you need to go and debit the cash, or you can also debit a special account called cash in transit. You can debit cash directly, debit bank, and credit the receivable or current account for this amount that are due from from each other. For the amount due, meaning that this is under the asset section, the current account that is under the asset section. And then you may also have to adjust for goods in transit. For goods in transit, you also have to assume as if the goods had been received. So the adjustment that is needed is for you to debit the inventory, which is related to goods in transit, and you need to go and credit the accounts payable or the current account that applies or that appear in the liability section in the consolidated in the statement of financial position. Sorry. So that one is representing the amount owing. If the current account under the liability section, that represents amount owing to. And if the current account is under the asset section, that represents the amount due from. So we need to go and cancel off the current account balances. So what you can conclude is that any current account balances shouldn't be disclosed in the consolidated statement of financial position. It has to be cancelled off, and that might due to cash in transit and goods in transit as the causes of the difference. Now we move on to bills payable and bill receivable. The group members may also issue some legal document in the form of negotiable financial instruments, which can be used by the holder or the payee to pay another party. These may give rise to what you call notes or bills receivable. And it also may give rise to notes or bills payable as the transaction happen between parent and subsidiary. Maybe the issuer is the parent, so that is a notes payable to the parent. However, the payee is the subsidiary, so therefore it will be the bill or note receivable to the subsidiary company. And these transactions are also intra-group or intercompany transaction, and we need to do some adjustment. So some of these intercompany bills receivable, intercompany bills payable that appear in the separate account of the holding and subsidiaries, their own separate account, may have been paid. Some of the bills may have been settled by the payee to the issuer. At times, these intercompany bills may also be discounted by the discount houses or financial institution. Either the intercompany bills are being discounted in full or being discounted just part of it, maybe partly or fully discounted. So if that is the case, we also need to take into consideration before we perform our consolidation adjustment. When the intercompany bills appear in the separate account of holding and subsidiaries are being discounted, what we need to do is, for consolidation purpose, we need to do cancellation of intercompany bills, but the cancellation of the intercompany bills payable and bills receivable are just limited to the undiscounted bills only. Remember, it should just be the undiscounted bills that were being cancelled or eliminated in the case of adjustment for the intercompany bills. For details, you can refer to the textbook again, note 10.8.4, page 374. You can also self-study the textbook example, which is example 14 at page 375 to page 378. And now I'm coming with my own example. This is a work example 3 because work example 1 and work example 2 is on the fair value adjustment, the consolidation issues on fair value adjustment. Our consolidation issue today is on intercompany transaction and balances. So here I have with me work example 3, which will illustrate and show you a work example on cash in transit, intra-group loans, intra-group receivables and payable, and intercompany bills payable and receivable. And you have the statement of financial position of two separate company. One is called whole, the other is called sub. The year end is 30th of June 30th of June year 4. This is the year end. And the year end normally is your RD or reporting date. Right. You have the information given here: current assets, trade receivables, loan, and bill receivable. Current liabilities, you have the trade payable, loans from whole, and bills payable. This example will not touch about the impact in the group profits because we are just focusing on what are the impact of asset and liabilities if that relates to intercompany transaction. So our focus is more on the asset and liabilities. So you have the additional information at your right hand side there, where there are three additional information, and we will go through the information each at a time. This is the information given. Whole Berhad is a holding company. You are not informed what is the percentage acquired. Has lent 30,000 to Sub Berhad. Sub Berhad is a subsidiary company. When the holding company lend some money to the subsidiary company, this is an intercompany transaction because the transaction is between group members. On 30th June year 4, subsidiary company has remitted 3,000. Subsidiary has made some payment out of this 30,000. So meaning to say that out of this 30,000, 3,000 is being paid. 3,000 is being paid, but let me just get back to that. 3,000 is being paid but has not been received, and remaining 27,000 is unpaid. So 30th June, that is what happened. However, whole Berhad only received the payment. The payment was received, but it was received on 4th of July. 4th of July is after reporting date. So meaning that it was not received on the date you prepare your statement or your consolidated financial statement. So that was the first one. The second one is regarding goods being sold on credit. That was 10,000. So this is regarding intra-group sales, intra-group purchase, where the goods that was on credit are still within the record of the parent and the subsidiary. Number 3 is regarding bills payable, where 20,000 of the bills payable in subsidiary relates to the bills receivable in whole Berhad, which also imply that this is intercompany bills. And here you have information regarding what are the bills that were being discounted, 5,000 of the bills. And that was discounted with a finance company. So you are required to prepare the consolidation journal entries to adjust the above transaction. I'm going to show you according to 1, 2, and 3 separately. And also an extract of consolidated statement of financial position as at 30th of June year 4. So I'm now focusing on the first one. Yeah, the first one is regarding the intercompany loan as well as cash in transit. I'm going to show you how do we cancel off the intra-group loans because intra-group loan shouldn't be reported. So here you can see one item under current asset, loan to subsidiary. So meaning that loan that is made by the parent to the subsidiary, the loan is 30,000. Yeah, that loan. And there's another item where you have loans from whole Berhad, 27,000. So you can see that there were differences between the two balances here. the difference is 3,000. And you are informed in information number 1 that 3,000 was being paid. Yeah, the payment was made by the subsidiary company. However, the payment has not reached the recipient until 4th of July. 4th of July is after 30th of June. So therefore, it reached the recipient later. So what you need to do is you need to perform consolidation adjustment for that intercompany bills. So the elimination of intra-group loans between holding and subsidiary, this must be eliminated. This intercompany, it should be here, sorry. It shouldn't be here. It should be here, the second one. So let me just make a correction here. So it should be this 30,000. This is the one that needs to be adjusted, this 30,000. So the difference between that loan, not the trade receivable, the loan. So the loan to subsidiary and the loan from holding. So you need to eliminate. So debit loans from whole, 27,000. That 27,000, the one that is in this so-called purple box. The next one is for you to go and cancel off the loan to subsidiary. So you will have to credit the loan that is under the asset section, and you will have to debit the loan that is under the current liability section. And you can see that the difference is 3,000, and you were informed earlier the difference was due to cash in transit. So what you will do is you will go and debit cash in transit, or you can just debit cash with that 3,000, and this is the one that you will report in the consolidated statement of financial position. That will be done later. Now we go to the next one. The next item that I will be explaining is on intra-group receivable and intra-group payables. You can see here in the second information, we have already dealt with the first one. Whole berhad sold goods on credit. Sold goods on credit means you do not make payment immediately. You make payment depending on the terms and condition. The goods on credit was 10,000, and as at the date the financial statement is being prepared, no payment has been made. So meaning to say that the subsidiary has not made payment for that 10,000, and that gives rise to intercompany accounts receivable or intercompany accounts payable. To the holding, subsidiary is the accounts or trade receivable. To the subsidiary, the holding company whole berhad is the accounts payable or the trade payable. So therefore, to the subsidiary company, this is a purchase, credit purchase, but to the parent company, this is a credit sales. So let's see. The trade receivables, 30,000 here, also include some goods sold on credit. So you can see here that 10,000 is actually intercompany, and remaining 20,000 is the one related to outsider. I put here outsider. That was what you have. So the one that is related to intercompany is the one that you need to go and cancel off, which is this 10,000. The next one, you need to go and cancel off, and you just need to report the 20,000 in your trade receivable plus the one under subsidiary. We'll show you that later. And then trade payable, the trade payable is 15,000. Remember I told you earlier, to the subsidiary company, this is a purchase. So the 10,000 purchase that was made on credit give rise to trade payable. So that 10,000 here is intercompany purchase, credit purchase that later appear in the trade payable. So the 5,000 is the one related to other. So these two item, 10,000 trade receivable and 10,000 trade payable, must be cancelled off. So what you need to cancel off is to eliminate the intra-group trade receivable and trade payable because no payment has been made. If there are some payment that has been made, you may also need to go and adjust the cash account. But here you just need to go and credit the asset account with the 10,000 which are intercompany trade receivable, and go and debit the liabilities account, the trade payable, with the 10,000 which is the intercompany trade payable. This is because of the credit purchase and this is because of the credit sales, which both are between group members. We go to the next one. The next one, which is the last one in this example, example 3.3. So we're now dealing with intercompany bills payable and receivable. So you have these items that are of our focus now, the third one in the additional information. 20,000 of bills payable of Sub-Berhad. Sub-Berhad is the subsidiary. And that 20,000 bills is related to bill receivable in whole. So if you look at whole here versus sub, okay. Just to let you know that out of this 20,000, 26,000, 20,000 is intercompany. So this is intercompany. Same goes here. Out of this 25, 20,000 is the intercompany transaction. 5,000 is the transaction with other parties or outsiders. I put here outsider, or also known as the third party. So what you need to cancel off? Do you need to cancel off 20,000? That not so fast. 20,000 is just the intercompany bills. Remember, I have explained earlier what you need to cancel off is the undiscounted bills. So let us look at what has been discounted first. The company has discounted 5,000 of the bills. So the undiscounted bill is 20 minus 5, 15,000. So let's just look at what we have in the working here. So for the working purpose, the bills payable was 20,000. The bills payable here is the intercompany bills. And that was the bills payable of the subsidiary. So I put S for subsidiary. The discounted amount was 5,000. So you need to reduce that 20,000 with 5,000. So that will give you the undiscounted bills of 15,000. And this undiscounted bill of 15,000 is the one that need to be adjusted. So you are going to eliminate the undiscounted intra-group bill receivable. For the one that is being discounted, there is no journal entry, but you are going to do the consolidation adjustment for the undiscounted bill. So you will debit bills payable of the subsidiary with 15,000 undiscounted bills. And you are going to credit bill receivable of holding company with the same 15,000. And this, all three transactions here, all these three adjustments will now be shown, or the effect of that will be shown in the consolidated statement of financial position as follows. So these are the result of what we have done. For example, trade receivable. This is related to information number 2, where we adjust for the intra-group balance of 10,000 for the amount that relates to group members. So therefore, you will just add the one of the holding, trade receivable, plus the one of the subsidiary, H or P plus S, right? Parent plus subsidiary, or holding plus subsidiary, and minus the intra-group balance. This one is what we do in our elimination. If you perform a consolidation worksheet, this will be actually credited or reduced against the trade receivable. The second one is cash in transit. You can also include cash here, or you can adjust under cash, the cash in transit. So first, the cash in transit is as a result of the differences in the intercompany loan. So that was from transaction number 1, so 3,000. Bill receivable is as a result of transaction number 3, where we just adjust for the undiscounted bills of 15,000. So you add the holding plus the subsidiary, and the elimination is for the undiscounted bill. So this is the elimination, and the elimination is for the intercompany transaction. For the current liability section, you have the trade payable that you need to add holding and subsidiary, and minus the intercompany. This 10,000 is the intra-group trade payable, and you have 45,000, and 26,000 is the one of the subsidiaries bills payable, and 20,000 is the bills payable of the parent. This is from information number 3. I have put some cross-reference there, and minus the undiscounted bills. I have calculated the undiscounted bill. Remember, undiscounted bills is what you make adjustment for, so that gives you 31,000. So we are done with this work example 3. I will go in my next video for work example 4, which is exclusively on bills payable with different scenarios. I thank you for watching. I will see you when I will see you. Please go and revise more, and go and watch my next video. With that, Assalamualaikum, and have a good day.